Ladies and gentlemen, welcome to the Vogel CCIM competition. Thank you for taking the time to watch and review our presentation. Allow me to introduce my partners and I. My name is Taylor Morales, Public Relations Manager. I am joined in order by CEO Avery Keller, COO Karen Thrasher, CMO Nihal Ali, Construction Manager Marcos Tapia, and CFO Nathan Huesman. Together we are Success Commercial Real Estate. Our motto, which we firmly believe, when you expect success, call success. Let us begin. Prestige Industrial Park is an industrial real estate investment located in San Antonio on I-35 and 410. The initial project will be on 30 acres with approximately 250,000 rentable square feet, with the possibility of expansion to close to 65 acres and 500,000 rentable square feet. Industrial real estate is the hottest form of real estate in San Antonio. Currently, online shopping accounts for 15% of all retail sales, which is close to $500 billion and is poised to grow in coming years. San Antonio is also growing at a high rate, and with USMCA set to be ratified sooner than later, San Antonio's position on the I-35 NAFTA Superhighway signals a need for more large-scale industrial performance. Our building is a tilt-up cold shell distribution spec structure with a considerable amount of paved court. San Antonio continues to grow as a city with an expected average growth rate of around 9% in a 5-mile radius of our property in the next 5 years. As mentioned before, San Antonio's industrial market is very strong. The market is approaching close to 100 million square feet in space with an 89% occupancy rate and an average of $5.20 per square foot in rent, which is right on our par with our own project. Now I will be passing the focus on to CEO Avery Keller. Thank you.
The market report provided by CBRE has highlighted some of the insights from Q4 to Q1 and has also given us some information about COVID-19 and how the industrial industry is likely to respond. So from Q4 to Q1, we see that vacancy rates are staying pretty steady, going from 11.6 to 11.7%. In the Northeast submarket, Class A properties had a decrease of vacancy due to the high demand of premium space for tenants. Additionally, we see that asking rates in Q1 have actually increased to over $5 per square foot, and this is the first time we're seeing this happen since 2015. It's also stated in the report that industrial real estate is expected to make a little bit of a quicker recovery than some of the other sectors of real estate, such as retail and transportation, and hopefully we see this happen as soon as Q3. Class A buildings like ours will be in especially high demand as we see an increase of big distributors looking to domesticate their manufacturing. So though there is some uncertainty still surrounding this topic, we're confident that the need for industrial space will continue to grow, and we're very well positioned in San Antonio to fulfill those demands due to our surplus of land and competitive pricing compared to some of the surrounding cities.
Our development is located at 4201 Milling Road in San Antonio, Texas. Access to our site can be found on Old Seguin Road right off of Loop 410's Access Road, as well as Milling Road. It's located less than 5 minutes from multiple highways, and it's also near the HEB facility on Rittiman. Our site's location is easily accessible and close to many opportunities. Our land was originally offered at $3.25 per square foot, but we were able to secure it at $3. The site sits on almost 65 acres, however we secured just 30 acres, with an option to purchase the rest of the 34.8 acres in the future for future development at the same price, which we hope to take advantage of once our project is stabilized. Our 30 acres purchased at $3,920,400 comes already platted and is zoned I-2 heavy industrial use. It comes with an environmental report showing no protected classes as well as soil and gradient surveys of the parcel. Utility access is adjacent to the highway and is served by SAWS and CPS. Moving to our site's plan, Phase 1 of our development will feature a 250,000 square foot cross-dock industrial warehouse on the northwestern part of our site. The owner of the remaining land has granted multiple easements. The first one allows us to build access through to Milling Road egress, giving us multiple access points to the property. The second allows us to build the full detention pond, which impedes into the remaining 34.8 acres. The project will also feature 250 parking spaces for employees and trucks, as well as outside storage. The property is not located in a flood zone and has minimal flooding risk. However, there is a ditch on site with steep gradients that will be converted into our detention pond. Future development on the land will include 3 more large rear-loading industrial warehouses with additional parking.
With our second, third, and fourth warehouses planned for future development, our main priority right now is going to be putting up the 250,250 rentable square feet for Warehouse 1, our largest warehouse. This warehouse is going to feature 200 loading bays, cross-dock loading, a clearance height of 36 feet, be 140 feet deep and 30 feet wide. Because of ongoing delays due to the coronavirus, we hope to close on the land sometime in July, so our 90-day due diligence period can begin and we can shoot to have construction start in the fall. If construction stays on track, we're hoping to have the warehouse completed by the beginning of 2022, so we can have tenants move in February of 2022. Then our 2 to 3 year stabilization period will begin, where we'll be making continuing improvements on the site during this time. We're aiming to sell once the property is stabilized sometime between 2024 and 2025. Once our due diligence period has expired, we'll begin the pre-development phase of construction, where land will be cleared and site work is going to commence on the property. We're aiming to have this initial portion of our construction completed by February of 2021. Then we'll be able to start foundation work and the structural framing of the building. Because we're using tilt-up walls, we're hoping to expedite the process so we can be putting the finishing touches, such as electrical and plumbing, by the end of 2021 into the early part of 2022. As for our project cost, the greatest portion is our hard cost, which account for 55% of total cost. These include site work and land acquisition cost, but our financing costs are the ones that account for the least amount, which is only 2%. Our total project cost comes out to $17,340,000, which is about $69 per square foot. Our total site cost account for about 23% of our overall project cost at $3,900,000. Our total hard cost, of course, account for the most at $9,550,000. Our soft cost account for just 7% of our overall cost, and that is with us charging a 2% developer's fee, which comes out to around $400,000. Our total allowances accounts for $2 million, that is $350,000, and our total financing cost, of course, are the least amount of our cost at just 2%.
We feel our project is perfect for the current market, as it can be positioned towards a multitude of businesses that are experiencing an overall period of growth, especially with everything that's going on right now. These include last mile distribution, automobile manufacturing, and logistic companies. These are suppliers that are already located in San Antonio and are looking for additional space or for the possibility of relocating. And another interesting option is having H-E-B suppliers as our tenant. Actually, our location is within the radius that the H-E-B warehouse on Rittman stipulates that its suppliers need to be located within. This will prove to be a big benefit for us. We have already agreed to pre-leasing terms with Forward Air. For those unfamiliar with the company, they are leading in transportation and logistics service providing in North America, and we believe they are the perfect fit for the tenant mix that we are striving for. They will be moving in with 6 months of free rent and be paying $5.25 per square feet. This will be a triple net lease with a 2.5% annual bump in that lease, and we will also be giving them $7 in tenant improvements per square feet. They will be occupying 125,125 square feet, which is half of the initial structure that we are planning on building. We couldn't be more excited to have Forward Air as a tenant and feel like the lease is a great addition to our project and that is in line with comparable leases in the market.
The sales comps that we compiled were a part of a large portfolio purchased by Blackstone. So since these buildings didn't have individual cap rates, we ran an assumed stabilized cap rate analysis to determine some probable rates for each of the buildings as a reference. So our projected net sale price is $21.88 million with 250,250 square feet of rentable building area. This puts our price per square foot at $87, which is on par with the comps in our area for the past year. We priced out our rental rate of $5.25, primarily based on the Pan Am West Industrial Park building that is located in San Antonio. This building has a rental rate of $5.30. So in order to be competitive in the market and ensure that the property will be occupied, we're also offering $7.50 per square foot in tenant improvements and 6 months free rent as an incentive to our tenants. We purchased our land for $3 per square foot on 30 acres, so this puts our price per acre at $130,700. While this figure is a little bit higher than some of the comps in our area, we decided that we are willing to pay a slight premium for this property due to the location of this site being in such an industrial part of the city and having really easy access to 410, I-10, and I-35.
Diving straight into financials, we were able to secure a semi-perm loan for 250 basis points over LIBOR. The LIBOR rate actually given to us by Broadway Bank was just 40 basis points. However, because it was so low, to be conservative, we imposed a cap in our own pro forma of 100 basis points. Our year 5 NOI is just under $1.4 million, with a debt service coverage ratio of 1.75 and a cash-on-cash return of 13.6% annually. In an analysis for the project as a whole, and assuming a conservative cap rate of 6%, we are looking at $7.6 million in profit after the pref and initial equity investments have been repaid to you, the investor. This gives us an IRR of 28.4% for the entire project, which we couldn't be more excited about. We also have an equity multiple just above 3 and a cost cap or yield to cost just over 7%. With a 75% debt leverage, we need $4,350,000 to get this project off the ground. After our own contribution, we are asking for an investment of $3,950,000 to begin developing. We anticipate the stabilization and sale of this project in year 5. Our conservative estimate to the investor's share of gain is just over $8.4 million, with a share approaching $10 million on a more optimistic cap rate. To summarize our project, we're developing a Class A industrial building with the potential to develop into a full industrial park. We've chosen this development because of San Antonio's robust industrial market and the rising need for distribution space, not just in San Antonio, but across the country. Our project offers a 1.2% development spread, a 1.75 debt service coverage ratio upon stabilization, and an anticipated 28.4% IRR on the project upon sale. We also want to say a huge thanks to David Weeder and Derek Rawson, our mentors this semester, Aaron Perensky, our civil engineer mentor, and Andra Ozuna, our finance mentor, Rob Burlingame of CBRE, Daniel and Giselle from USA Realco for being our mock judges, and Laura and Professor W for being able to adapt on the fly this semester and still salvage this wonderful opportunity to be able to present, and also Sandy Wolf at Catamount Construction for our construction information. Thanks.